Welcome back to Investing Talk Podcast.
Good to be back.
Today we're diving into Kenvue. Now, this is one of the biggest consumer health companies out there.
Absolutely. We're talking Tylenol, Motrin, Neutrogena. These are massive household brands, global reach.
Exactly. Staples. So the big question we're tackling today, based on our sources, is this. Is Kenvue actually a good buy right now?
That's the million-dollar question, isn't it?
It really is.
Yeah.
But before we get into the thick of it, just a quick reminder to please subscribe, like this discussion, leave a comment. We really value your feedback.
Yeah, definitely.
And hey, if there's another company you're curious about, let us know in the comments below. We might just look into it next time.
Please do. Now, Kenvue, it's fascinating right now. Looking at the research, it's really at a crossroads.
How so?
Well, you've got this incredible brand strength, right? And the valuation on paper looks pretty attractive, maybe even undervalued.
Yeah.
But, and it's a big but, you're seeing a lot of near-term noise, volatility. Plus, there's significant debt from the spinoff, and then there's this dividend.
The dividend. We'll get to that.
Yeah, the payout ratio is, well, questionable. So it's this classic balancing act. Potential value versus some very real risks.
Okay, let's start with that volatility then. The price action recently has been pretty dramatic.
It really has.
The stock recently hit $16.89. And the key thing here is that's not just a random number, that's its 52-week low.
Literally trading at the floor. That's often a psychologically important level for the market.
So what triggered this big drop? Because Kenvue isn't usually that volatile, right? Its beta is pretty low.
Right. Its beta is about 0.78, so typically it moves less than the broader market. But on September 22nd, bam, it dropped over 5%.
In one day. Wow.
Yeah. And the trigger, according to the sources, seems to be reports connecting the current U.S. administration with potential policy changes, things that could impact the consumer health sector specifically.
So regulatory risk perception suddenly spiked.
Exactly. It really highlighted how sensitive the stock, or maybe investor sentiment about the stock, is to this kind of macro news right now, even for a typically stable company.
Which is interesting given those strong brands you mentioned.
It shows sentiment is fragile.
Yeah.
And technically, this is where it gets quite interesting.
Go on.
That big sell-off pushed Kenvue deep into what technicians call oversold territory. The 14-day RSI, the Relative Strength Index, dipped to around 25.87.
Okay, and for listeners maybe not as familiar with the RSI, below 30 is usually the signal.
That's the classic threshold, yeah. Below 30 often suggests the stock has been sold off too hard, too fast, and might be due for a technical bounce.
But it's not that simple, is it?
Definitely not. Because while the chart pattern might be flashing oversold, the overall short-term market mood around Kenvue still seems pretty bearish. You can't just rely on one indicator.
Right. Technicals might suggest a bounce, but you need the fundamentals to back it up long-term.
Precisely. So let's put the charts aside for a second and look under the hood.
Yeah.
Fundamentally, Kenvue is a giant. Trailing 12 months revenue, the sources put it at $15.14 billion.
That's substantial. And the margins, those brands must give them some pricing power.
They do. Gross margins are strong, around 58%. And the EBITDA margin is solid too, but 20.1%. That reflects the strength in their core areas: self-care, skin health, beauty.
Okay, wait, let's pause there. EBITDA margin. For our listeners who might be learning, can you quickly break down what that 20.1% tells us?
Sure. EBITDA is earnings before interest, taxes, depreciation, and amortization. It's a way to look at the core operational profitability.
Before financing and accounting stuff kicks in.
Exactly. So a 20.1% margin is quite healthy for a consumer staples company. It confirms they're running efficiently and getting good prices for those well-known products.
Okay, healthy margins, strong brands. But there was a flag in the sources about growth, wasn't there? Something about Q2 revenue.
Yes. That's the flip side. While the margins look good, the most recent reported quarter, Q2 2025, saw revenue actually fall by 4% compared to the year before.
Down 4% year on year. Is that a Kenvue-specific issue, or was the whole sector weak? Because falling revenue, even with good margins, is definitely a concern.
That's a great question. The sources suggest it's a bit of a mix. Part of it relates to divestitures and portfolio changes after the Johnson & Johnson spinoff. So year-over-year comparisons are a little messy.
Okay, some structural noise.
Right. But there was also some reported softness in parts of their skin health business, especially internationally.
Yeah.
So it wasn't just accounting artifacts. There were some operational weak spots, too. It definitely puts a question mark over future growth momentum.
And that revenue dip becomes even more important when you look at the balance sheet, right?
Yeah.
Specifically the debt.
Absolutely, critical connection. There are two big financial risks highlighted, and they're linked. First, the debt load. Kenvue is carrying over $7.05 billion in long-term debt.
7 billion. Wow, that seems like a lot even for a company this size. Why so much?
It's largely a consequence of the spin-off structure. Basically, Kenvue took on debt to pay a large special dividend back to Johnson & Johnson as part of the separation deal.
So they leveraged up to facilitate the split.
Pretty much. Now, their interest coverage ratio is okay for now, around 6.6 times. They can cover the interest payments, but that much debt makes them vulnerable. If costs rise due to inflation, squeezing margins, or if interest rates go it further, that debt service becomes a much bigger burden on cash flow. It reduces flexibility.
Okay, so debt is risk number one. What's the second big one? You mentioned the dividend earlier.
Yes, the dividend sustainability. Kenvue pays out $0.83 per share. That gives it a really attractive yield right now, about 4.89%. Looks great for income investors on the surface.
But the payout ratio.
The payout ratio is over 112%.
Okay, unpack that. Over 100%. What does 112% mean practically for an investor?
It means the company is currently paying out more cash in dividends than it's earning in net income.
So the dividend isn't covered by current profits? Where's the money coming from?
Good question. It could be cash reserves left over from the spinoff, or potentially, and more worrisomely, it could mean they're funding it through other means, maybe even more debt down the line. It's not sustainable.
Right. So unless earnings rebound significantly and fast,
management faces a tough choice. Cut the dividend to match reality, which would likely upset income investors and hit the stock price, or keep paying it and potentially strain the balance sheet further, slowing down debt reduction.
that's a major dilemma. Okay, so with this backdrop, the stock near its lows, the volatility of the debt, this dividend issue, what are the key things investors should watch for in the next, say, 3 months?
All right, number one is definitely the Q3 2025 earnings release. That's the next big data point.
When is that expected?
Sources had slightly different dates, interestingly. One said October 18th, another suggested November 6th.
Okay, so sometime mid-October to early November.
Right. Regardless of the exact date, that report is crucial. We need to see if that Q2 revenue dip was just a blip or the start of a trend. We'll also listen closely to what management says about tackling the debt and growth outlook.
Beyond earnings, anything else on the calendar?
Yeah, a couple of market structure things. There's a major consumer staples ETF rebalance scheduled for October 31st.
How might that affect Kenvue?
Rebalances can cause some buying or selling pressure as index funds adjust their holdings. It might not be huge, but it can influence short-term flows. There was rebalance back in July that seemed to give the stock a modest, temporary lift.
Interesting. What else?
Then there's a date for notable institutional buy disclosures on November 15th.
Why is that one important for, say, our learner audience? Why track institutional buying?
Think of it as a confidence gauge. When big long-term investors like pension funds or endowments make significant buys or sells, it tells you what the smart money thinks about the company's long-term prospects.
So if big institutions start adding Kenvue shares, it could signal belief in the turnaround story or the valuation.
Exactly. It's a barometer for long-term conviction.
Okay, those are the scheduled events. What about the rumor mill? Any speculative catalysts analysts are buzzing about?
There's definitely some chatter. One persistent bit of speculation is about an accelerated spin-off of any remaining legacy assets from J&J. That could potentially simplify the Kenvue story.
Makes sense. What else?
Also hearing talk about potential new product launches and maybe a bigger push into faster-growing markets, particularly Asia and Latin America, that would directly address the growth concerns.
Right, trying to boost that top line.
And then there's debate about whether Kenvue might announce a share buyback program using cash to buy its own stock, which can boost earnings per share.
Though with that debt and dividend payout, you wonder where the cash for buybacks would come from.
That's the debate. And finally, just general sector talk. Kenvue, with its brands, is sometimes mentioned as a potential acquisition target for an even larger global consumer company.
Always a possibility in that space. Okay, let's try to pull all this together. We've got strong brands, high debt, dividend risk, potential catalysts, split analyst views. What's the synthesis?
Well, the analyst consensus reflects that uncertainty. It's pretty split between buy and hold. The average price target is around $24.04.
Okay, about $24.
But what's really striking is the potential gap based on intrinsic value calculations. The discounted cash flow, or DCF, analysis in our sources pegs the fair value much higher, around $27.82 per share.
And just to remind folks, DCF tries to estimate value based on future cash flows. So $27.82 compared to the current price near $17, that suggests significant undervaluation.
Yeah, roughly 24% upside to that DCF estimate if you believe the model's assumptions. That's the core of the bull case.
So putting it all together, the sources gave an overall rating.
They did, an overall investment rating of 6.5 out of 10.
6.5 out of 10. So not a slam dunk buy, but not a sell either. Cautiously optimistic, maybe.
That sounds about right. It perfectly sums up the conflict. You've got this apparent discount, these powerhouse brands, but you're weighed down by operational softness, that big debt number, and the very real risk around the dividend payout.
So for someone thinking about buying now, it really depends on their time frame and risk tolerance.
Absolutely. Short term, it looks risky, high volatility, negative sentiment. Yeah, you might get technical bounces off the oversold levels, but it could easily go lower too. It's a trader's gamble, perhaps, not a safe bet.
And longer term.
Longer term, it potentially fits a specific type of investor profile.
Which is?
Someone patient, value-focused.
Yeah.
Someone willing to stomach the near-term choppiness, tolerate the debt risk, and essentially wait for things to normalize. Either organic growth needs to kick back in strongly enough to support that dividend and debt reduction, or management needs to make a tough call on capital allocation. Maybe cut the dividend, get serious about paying down debt. You're buying quality brands, yes, but you're also buying into a situation that needs careful management and maybe some difficult decisions ahead.
That sums it up well. The core tension, that potential undervaluation and brand strength versus the very real financial constraints of the debt and that stretched dividend.
Precisely. And maybe this leaves you, the listener, with a final thought to chew on.
Okay, let's hear it.
If you were running Kenvue today, facing that 112% dividend payout ratio, what's the priority? Do you keep paying that attractive dividend to keep the income investors happy, even if it strains the finances? Or you make the tough call, slash the payout, and aggressively use that cash to attack the $7 billion debt pile?
That's the strategic crux, isn't it?
It really is. The path they choose on that specific issue will likely define Kenvue's risk profile and its stock performance for years to come.
A lot to think about there. Really insightful stuff. We hope this look through the sources helps you navigate your own investment decisions around Kenvue.
Hope it was helpful.
Thanks, everyone, for tuning in to Investing Talk Podcast. We'll catch you next time for more learning.